8 strategic assets can beat inflation's effects. In this video, you'll learn about 8 ways in which rich people make money with inflation. Let's begin. Currently, the U.S. is experiencing an inflation rate of 3.67%, an uptick from the 3.18% observed last month. Although this rate is significantly lower than the high of 8.26% from the previous year, it's crucial to understand what this means for consumers and investors. As inflation increases, the buying power of money decreases. In simpler terms, your dollar today might not stretch as far tomorrow. This trend affects everyday consumers because goods and services become pricier, making it harder for them to maintain their standard of living. Investors often face diminished real returns on their investments due to inflation. However, not all investors find themselves on the losing end during inflationary periods. Surprisingly, some see this period as ripe for opportunity. These are 8 places where rich people strategically allocate their investments during inflationary times. Asset number 8. Gold, silver, and precious metals. During inflationary periods, rich individuals often turn to precious metals like silver and gold as investments for several reasons. Value preservation. Silver and gold have a long-standing reputation for maintaining their value over time. This means that when traditional currencies like the US dollar are losing their value due to inflation, these precious metals often remain relatively stable. In other words, the purchasing power of silver and gold tends to hold up, making them a safe haven during inflation. Historical performance. While both silver and gold are valuable metals, gold has historically outperformed silver during inflationary periods. Gold is considered a reliable store of value, and its price tends to increase as inflation rises. Investment options. If you're interested in investing in silver or gold, you have 2 main options. Direct purchase. You can buy silver or gold in various forms such as coins, bars, or bullion. However, it's essential to note that this approach may come with some challenges, particularly ensuring the authenticity of the precious metal. Without expertise, you might risk overpaying or acquiring counterfeit products. Exchange-traded funds, ETFs. An alternative method is to invest in ETFs that track the value of these precious metals. With this approach, you're not purchasing the physical metal itself, but rather investing indirectly through a professionally managed fund. This method is generally less risky and offers a level of diversification. In summary, gold and silver are considered solid investment options, especially during inflation, due to their historical stability and value preservation characteristics. While gold has historically outperformed silver, it's important to weigh the pros and cons of direct purchases and ETF investments to optimize returns and minimize risks based on your financial goals and risk tolerance. Asset number 7. Various commodities. Commodities are another asset class that attracts rich investors, particularly during inflationary periods. Here's a more detailed explanation. Inflation hedge. Commodities are considered an attractive investment during inflation because their prices often rise. When the general price level in the economy increases, commodities become more expensive, and this trend presents an investment opportunity. Investors can potentially profit from the rising prices of these essential goods and materials. Supply and demand. Dynamics. The prices of commodities are closely tied to the principles of supply and demand. As the demand for a particular commodity increases while its supply remains stable or decreases, its price tends to rise. Conversely, if demand drops or the supply surges, prices may fall. Therefore, investing in commodities requires an understanding of these market dynamics, and timing is crucial to maximize returns. Examples of commodities. Various commodities can be lucrative investments during inflation. Some notable examples include oil. The price of oil is known to be sensitive to geopolitical events, economic trends, and supply disruptions. For instance, during geopolitical tensions or disruptions in oil-producing regions, oil prices can surge. The Russian invasion in February 2022 led to a significant increase in oil prices. Grain. Agricultural commodities such as wheat, corn, and soybeans are essential staples in the global food supply chain. Prices of grain commodities can rise during periods of supply shortages or increase in demand, leading to potential profits for investors. Cotton. Cotton is a soft commodity used in textiles and clothing. Price increases in cotton can result from factors such as weather conditions affecting cotton crops or shifts in fashion trends. Challenges and risks. While investing in commodities offers potential returns, it's important to note that it's not a surefire win. Prices can be volatile, and not all commodities are suitable for long-term investments. For instance, perishable commodities like avocados or strawberries may not be practical investments due to their short shelf life. Investment options. To invest in commodities, you can consider exchange-traded funds, ETFs, that track specific commodity indexes. ETFs offer a way to diversify your investments across various commodities without needing to handle the physical goods. This approach is generally more accessible and less risky for individual investors compared to directly trading commodities. In conclusion, during inflationary periods, various commodities offer an attractive investment opportunity as their prices tend to increase. Understanding the principles of supply and demand for specific commodities is essential for successful commodity investing. Investors need to carefully time their investments and consider using commodity-focused ETFs to gain exposure to this asset class. Asset number 6, cryptocurrency. Cryptocurrency is a relatively new and technologically complex asset class that has been gaining attention from investors. Here's a more detailed explanation of why it's considered an intriguing asset, especially during inflation. Potential for high returns. Cryptocurrency has attracted investors due to its potential for significant returns. It has demonstrated impressive growth and substantial price increases over the years. For example, Bitcoin, the most well-known cryptocurrency, has experienced substantial price appreciation. Limited supply. One of the key factors that make cryptocurrency intriguing is its limited supply. Many cryptocurrencies, including Bitcoin, have a predetermined maximum supply. For Bitcoin, this supply cap is set at 21 million coins. This limited supply means that new coins are not created endlessly. Unlike traditional fiat currencies, which can be printed by central banks, cryptocurrencies are created through a process called mining, which is resource-intensive. This limitation in the creation of new coins is believed to contribute to the preservation of their value. Independence from traditional market. Influences. Cryptocurrencies are not controlled by governments or financial institutions, which sets them apart from traditional currencies. This independence makes them less susceptible to traditional market influences, such as monetary policy or economic events. Inflation of traditional currencies often results from the policies and actions of central banks. Cryptocurrencies operate on decentralized blockchain technology, which can provide a degree of insulation from these factors. Diversification and risk. Diversifying your investment portfolio into cryptocurrency is an option that some investors consider. It offers the potential for high returns. However, it's important to understand that the cryptocurrency market is highly volatile and prices can fluctuate significantly in a short period. This high volatility is one of the main risks associated with cryptocurrency investing. Therefore, it's crucial for investors to be aware of and accept these risks. Blockchain technology. Cryptocurrencies operate on blockchain technology, which is essentially a decentralized and secure digital ledger. The blockchain records all transactions transparently and immutably, providing a high level of security. This technology can offer a layer of trust and transparency in the cryptocurrency ecosystem. Diversified portfolio. For investors who are willing to accept the risks, diversifying their portfolio to include a small allocation of cryptocurrency can provide diversification and the potential for substantial returns. By including an asset class that operates independently from traditional financial systems, investors may be better positioned to protect their wealth during inflation. Limited supply. One of the key factors that make cryptocurrency intriguing is its limited supply. Many cryptocurrencies, including Bitcoin, have a predetermined maximum supply. For Bitcoin, this supply cap is set at 21 million coins. This limited supply means that new coins are not created endlessly. Unlike traditional fiat currencies, which can be printed by central banks, cryptocurrencies are created through a process called mining, which is resource-intensive. This limitation in the creation of new coins is believed to contribute to the preservation of their value. Independence from traditional market. Influences. Cryptocurrencies are not controlled by governments or financial institutions, which sets them apart from traditional currencies. This independence makes them less susceptible to traditional market influences, such as monetary policy or economic events. Inflation of traditional currencies often results from the policies and actions of central banks. Cryptocurrencies operate on decentralized blockchain technology, which can provide a degree of insulation from these factors. Diversification and risk. Diversifying your investment portfolio into cryptocurrency is an option that some investors consider. It offers the potential for high returns. However, it's important to understand that the cryptocurrency market is highly volatile and prices can fluctuate significantly in a short period. This high volatility is one of the main risks associated with cryptocurrency investing. Therefore, it's crucial for investors to be aware of and accept these risks. Blockchain technology. Cryptocurrencies operate on blockchain technology, which is essentially a decentralized and secure digital ledger. The blockchain records all transactions transparently and immutably, providing a high level of security. This technology can offer a layer of trust and transparency in the cryptocurrency ecosystem. Diversified portfolio. For investors who are willing to accept the risks, diversifying their portfolio to include a small allocation of cryptocurrency can provide diversification and the potential for substantial returns. By including an asset class that operates independently from traditional financial systems, investors may be better positioned to protect their wealth during inflation. In conclusion, cryptocurrency is considered an intriguing investment option, particularly during inflationary periods, because of its potential for high returns, limited supply, and independence from traditional market influences. However, investors should be aware of the associated risks and the high volatility in the cryptocurrency market before considering it as part of their investment portfolio. Asset number 5. Treasury Inflation Protected Securities, TIPS. Treasury Inflation Protected Securities, TIPS, are a type of government bond designed to protect your investments from the eroding effects of inflation. They offer a unique way to safeguard your money's real value. Here's a more detailed explanation of why TIPS are a valuable asset, especially during inflation. Inflation protection. TIPS are specifically structured to shield investors from the negative impacts of inflation. When inflation occurs, the prices of goods and services rise and the purchasing power of your money decreases. TIPS are designed to counteract this effect. Principal protection. With TIPS, your initial investment, known as the principal, is protected. This means that if you invest $1,000 in TIPS, the face value of your investment will increase with inflation. For example, if the inflation rate is 4%, your $1,000 investment becomes $1,040 in terms of purchasing power. Interest and inflation adjustment. TIPS not only protect your principal, but also pay interest. This interest is known as the fixed rate, and it is added to the principal amount semi-annually. The most critical feature of TIPS is the inflation adjustment. When inflation increases, the value of your TIPS bond rises and your interest payments also increase accordingly. This ensures that your savings maintain their value over time. Timing matters. To maximize the benefits of TIPS, it's advisable to buy them before inflation takes hold. If you purchase TIPS before an inflationary period, you can fully benefit from the increasing bond value and the rising interest payments as inflation climbs. Waiting until inflation has already set in may mean that your investments have already declined in purchasing power. Diversification and risk mitigation. TIPS are a solid choice for investors looking to protect their principal amount and ensure that their savings remain valuable over time. By including TIPS in your investment portfolio, you can diversify your holdings and reduce the risk of your wealth being eroded by inflation. Retirement and income security. TIPS are a popular choice among retirees looking to keep their money safe and secure a steady income. As inflation erodes the real value of traditional bonds, TIPS provide a hedge against inflation's impact. This ensures that retirees' fixed incomes can maintain their purchasing power throughout their retirement years. In summary, Treasury inflation-protected securities, TIPS, are a valuable asset during inflationary periods because they protect your principal investment from the negative effects of rising prices. They pay both a fixed interest rate and provide inflation adjustments, making them a reliable choice for maintaining your savings' real value over time. It's important to consider TIPS as part of your investment strategy, especially when you want to guard your wealth against inflation. Asset number 4, savings bonds, I-bonds. I-bonds, offered by the U.S. Treasury, are a unique investment option that combines fixed and inflation-adjusted interest rates. These bonds provide a way to protect your savings from the eroding effects of inflation. Here's a more detailed explanation of why I-bonds are a valuable asset for investors, particularly during inflation. Interest rates. I-bonds offer two types of interest rates. One is a fixed rate that remains constant throughout the life of the bond, and the other is a rate that changes based on inflation. This inflation-adjusted interest rate is tied to the Consumer Price Index for all urban consumers, CPI-U. It's reviewed and adjusted every 6 months based on the latest inflation data. Inflation protection. One of the primary features of E-bonds is their protection against inflation. Inflation is a phenomenon where the prices of goods and services rise, reducing the purchasing power of your money. I-bonds counteract this by providing an inflation-adjusted interest rate, ensuring that your savings maintain their real value over time. Flexibility and liquidity. I-bonds offer both short-term and long-term investment possibilities. While an I-bond will continue to grow in interest for up to 30 years, you aren't required to hold it for that long. You have the flexibility to cash out the bond after just 1 year, making it a liquid investment. However, if you decide to cash out the bond before the 5-year mark, you'll lose the last 3 months of earned interest as a penalty. Inflation adjustment. The inflation-adjusted interest rate provided by I-bonds ensures that your savings remain protected from the negative impacts of inflation. This means that when inflation occurs, the value of your investment increases. For example, if you buy an I-bond worth $1,000 with an interest rate of 0.3%, and after a year inflation rises by 4%, the value of your bond increases to $1,040. Instead of just earning $3 in interest, the total growth of your investment, considering the inflation adjustment, becomes $43, safe and reliable. I-bonds are considered a safe investment because they are backed by the U.S. government. This makes them a reliable choice for risk-averse investors looking to safeguard their money against inflation. Interest payment frequency. I-bonds pay interest to investors twice a year. This semi-annual interest payment provides investors with regular income from their investment, which can be especially appealing for those looking for steady cash flow. In summary, I-bonds are a valuable asset for investors, particularly during inflation, as they provide a combination of fixed and inflation-adjusted interest rates. They offer flexibility, liquidity, and protection against the eroding effects of rising prices. I-bonds are a low-risk way to diversify your investment portfolio and ensure that your savings maintain their real value over time. Asset number 3. Stocks. Investing in stocks is a popular choice among many individuals, including wealthy investors. Stocks represent ownership in a company, and they can provide opportunities for substantial returns. However, during times of inflation, investors often seek ways to protect their wealth. Here's a more detailed explanation of why stocks, particularly certain types, can be a valuable asset during inflation. Utility stocks and dividends. Utility stocks belong to companies that provide essential services like electricity and gas. These companies often pay dividends, which are payments to shareholders from their profits. What makes utility stocks appealing during inflation is their ability to increase their prices when their costs rise. This ensures that they remain profitable even in an inflationary environment. The dividends from utility stocks can provide a steady income stream to investors, helping to offset the eroding effects of inflation on their purchasing power. Stock index funds. While investing in individual stocks can be profitable, it also comes with higher risks. Many wealthy investors, during times of inflation, opt for stock index funds. These funds represent a collection of companies, often those listed in indices like the S&P 500 or the Dow Jones Industrial Average. Stock index funds offer several advantages. Diversification. By investing in stock index funds, you're putting your money into various companies at once. This diversification significantly lowers the risk associated with individual stocks. Stability. Stock index funds are considered safer during inflationary periods because they represent a broad cross-section of the market. They're less susceptible to the price fluctuations that individual stocks can experience. Affordability. Purchasing shares in stock index funds is often more affordable than buying shares in each of the individual companies they represent. This affordability makes it accessible to a broader range of investors. Passive management. Many stock index funds are passively managed, meaning they aim to replicate the performance of the underlying index. This approach often comes with lower fees compared to actively managed funds. In summary, stocks, especially utility stocks that pay dividends and stock index funds, can be valuable assets during inflation. Utility stocks provide a steady income stream, and stock index funds offer diversification and stability during uncertain economic times. These investments can help protect your wealth and mitigate the effects of inflation on your overall financial portfolio. In summary, stocks, especially utility stocks that pay dividends and stock index funds, can be valuable assets during inflation. Utility stocks provide a steady income stream, and stock index funds offer diversification and stability during uncertain economic times. These investments can help protect your wealth and mitigate the effects of inflation on your overall financial portfolio. Asset number 2. Debt can be an unconventional but strategic asset to consider during periods of inflation, and it can provide protection and income. Here's a more detailed explanation of how certain types of debt can safeguard your finances and offer investment opportunities. Leveraged loans and adjusted interest rates. Some types of loans, known as leveraged loans, have the unique characteristic of adjusting their interest rates. When inflation occurs, these loans can increase their interest rates to match the rising prices, providing a hedge against the eroding effects of inflation. Leveraged loans are typically used by corporations or investors to finance leveraged buyouts or other high-risk investments. These loans can help protect your money's purchasing power during inflationary periods, but they are not without their complexities and risks. Mortgage-backed securities, MBS. Mortgage-backed securities are financial instruments that are backed by a pool of mortgages. They can be an income-generating option. Here's how they work. When individuals or entities take out mortgages, their mortgage payments, including principal and interest, are bundled together into MBS. Investors can then purchase shares or bonds representing a portion of the cash flows from these mortgages. MBS can offer investors a stream of income through the mortgage payments. While they can be a source of income, MBS also come with risks, particularly related to the performance of the underlying mortgages. Collateralized debt obligations, CDOs. Collateralized debt obligations are complex financial products. They are essentially containers that hold various debt instruments, such as mortgages, auto loans, or credit card debt. Investors purchase different slices of these CDOs, each with varying degrees of risk and return. Some CDOs provide higher interest rates to compensate for the risk involved. They can be income-generating assets, but they are complex and can be risky. These investments became infamous during the financial crisis of 2007-2008. Caution and complexity. It's important to emphasize that investing in debt, especially complex debt instruments like CDOs, is not for the inexperienced or risk-averse. These assets can be challenging to understand and carry significant risks. Investors may need substantial capital to access some of these investment options. In summary, certain types of debt, such as leveraged loans and debt securities like MBS and CDOs, can provide protection against the effects of inflation while potentially generating income. However, these assets are intricate and carry risks, so it's essential to thoroughly understand the complexities and evaluate whether they align with your investment goals and risk tolerance. Consulting with a financial advisor is advisable before considering these options. Asset number 1. Real estate. Investing in real estate can be a sound strategy to combat the eroding effects of inflation and generate long-term wealth. Here's a more detailed explanation of how real estate investments can provide protection and growth during inflationary periods. Historical appreciation. Real estate, such as residential properties, houses and apartments, and commercial properties, office spaces, retail units, etc., has historically demonstrated the potential for appreciation in value over time. One of the primary reasons for this is the constant demand for housing. People will always need a place to live, and businesses require physical locations to operate. This demand helps ensure that real estate usually appreciates in value, making it an attractive investment during periods of inflation. Investment options. There are various ways to invest in real estate. Rental properties. Purchasing rental properties involves buying residential or commercial units and renting them out to tenants. Rental income can provide you with a steady stream of cash flow, which can be especially helpful during inflation when prices for goods and services rise. Additionally, the value of your properties may increase over time. Real estate investment trusts, REITs. REITs are investment vehicles that allow individuals to invest in a diversified portfolio of real estate assets without directly owning or managing properties. When you invest in a REIT, you're essentially purchasing shares or units in a trust that owns and manages various income-generating real estate assets, such as apartment buildings, shopping centers, or office complexes. REITs typically offer attractive dividend yields, making them an income-generating investment option. They are also relatively liquid because you can buy and sell REIT shares on stock exchanges. This can be especially beneficial if you need to access your investment quickly. Reduced management responsibilities. While investing in rental properties can be profitable, it often involves significant management responsibilities, such as tenant selection, property maintenance, and handling rental agreements. For individuals who prefer not to be directly involved in the day-to-day management of properties, REITs offer a hassle-free alternative. By investing in REITs, you can benefit from real estate's potential for appreciation and rental income without the burden of property management. In summary, real estate investments have historically shown the potential to appreciate in value, making them an attractive option to combat the effects of inflation. Whether you choose to invest in rental properties or opt for REITs, real estate can offer both income-generating opportunities and protection against the eroding purchasing power of your money. It's important to consider your financial goals, risk tolerance, and investment horizon when deciding which real estate investment option is right for you. Consulting with a financial advisor can help you make informed decisions tailored to your individual circumstances. Conclusion. While history has shown that real estate can perform well, especially during inflationary periods, it's essential to understand that there are risks. Rich individuals often diversify their investments to take advantage of opportunities during inflation. Thanks for watching, have a great day, and see you in the next video. Like and subscribe for more informative content.